Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist here at First Trust. Remember, we want to be the antidote to conventional wisdom. Well, the Dow is almost at 10,000, which is the forecast that we made earlier this year. And remember, on our videos, our Wesbury 101s, we've been talking about the potential for us to go back to pre-Lehman levels. And I've always felt that we could go above our 10,000 target, and it sure looks like that's going to happen today. We've already exceeded our 1,050 to 1,075 roughly target on the S&P 500. The Dow is just less than 1% away now from 10,000, and I believe it will breach that level. But let's go back a little bit and just remember where we came from this year. Early in January and February and early March, we were at panic bottoms in the economy. The fourth quarter was horrible. We had close to 6% drop in GDP in the first quarter. And then right there, the panic ended. The Federal Reserve started buying Treasury bonds, literally monetizing the debt, injecting currency into the system. And then possibly the most important change was the change in mark-to-market accounting, which happened right there in mid-March of this year, 2009. All of those things not only put a bottom in the economy and corporate earnings, but they put a bottom in the stock market. That's the key. So we bottomed at 676 on the S&P and about 65.47 on the Dow. And now from those lows, we're up roughly 60%. Now that we're at our targets, or very, very close to our targets, for the end of the year, December 31st, the question is, should we revise them or not? And I think we should. I think we should put a 12,000 target on the Dow. Maybe not by the end of the year. That's a lot to ask for in just the final couple of really 10 weeks or so of the year. But clearly by early next year, we could get back to that 12,000 level, which I consider to be kind of the pre-Lehman level. That would be about 1,225 or so on the S&P. And the reason for this is that we are now in a V-shaped recovery. Just about every piece of economic data, even retail sales, no matter where you go right now, somebody's saying, well, consumers aren't spending. That's just not true. Retail sales are up 3.9% at an annualized rate this year. That's excluding autos. Forget cash for clunkers. And that's after double-digit declines last year. I believe it's just a matter of time before we see job gains in the months ahead, and we will begin to see a self-sustaining recovery gather momentum throughout 2010, an economy that's literally hitting on all cylinders. As we've said many times in the past, it's what comes after that that we worry about. We're talking about a major overhaul of the healthcare system, really a government takeover of the healthcare system. We're talking about a major tax to deal with carbon emissions, and we're also talking about significant hikes in marginal tax rates. And I don't think it's very long before we're talking about a value-added tax. But I want investors to remember one thing about these: the health care bill, the carbon tax, the hikes in marginal tax rates, the potential increase in the value-added tax. Those are still years down the road. And what that means is that we have clear running room for the next 12 to 18 months. I continue to expect earnings to defy expectations. The economy is growing much faster than the pouting pundits of pessimism believe, and the conventional wisdom is just too dour about the future. So here we are. We've hit our targets early. It's always a little scary to raise your targets, but let me suggest that this momentum that we've seen will continue for at least the next 12 to 18 months. Good luck and good trading. And remember, we want to be the antidote to conventional wisdom. See you on the next Wesbury 101.